finally, it has come to my video of my 10 golden rules of investing. Because most Singaporeans, they don't lose money because they picked the wrong stock, but they lose money because nobody ever gave them a clear set of rules to follow before they started. So today, I'm going to give you my 10 rules that I wish that I had on day one that I can follow. And I'm going to give you the most important one last because it's the one that actually determines whether you can make the other 9 work. So how it works from rule 1 to rule 10 is that it's a systematic order. You need to start from rule 1 and rule 2 first because they are the prerequisite. Then as long as you progress along the way, then you would need the final rules. Okay, not Ken, right? And if you're new here, my name is Chris, the next chartered accountant turned personal finance YouTuber, and I talk about investing, personal finance, and retirement early on my channel. So you can give a follow on Honey Money SG. And let's start off with rule 1, the most important rule. Build your emergency fund first. This is not even investing advice. This is your survival architecture. Because I cannot stress how important your emergency fund is. Usually we give a benchmark around 6 to 12 months of whatever you spend. Your monthly expense multiplied by 6 to 12. And for most Singaporeans, that will be between 20,000 to 40,000 depending on how much you spend. But more importantly, it can be lower or higher, really. But more importantly is where you put them. I put my own liquid emergency funds in a high-yield savings account because I can deposit and withdraw whenever I like. And most likely my salary is credited there. So some of you prefer to put in SSB, but T-bill is not really recommended because there is a 6 months liquidity gap. Most importantly, these emergency funds need to be safe, capital protected, and you don't really go and chase for returns for this. I mean, a little bit of interest is fine, but other than that, it should be a place where it's your secured storage of cash. Once it's funded, you stop adding. It is not an investment account that you should DCA every month. It should be roughly around the same number, which is 6 to 12 months of expenses. So for myself, that is around 30,000 Singapore dollars for my entire family. But your number may be different, higher or lower, and that's okay because everyone have different family circumstances. So for mine, it's 30K. And let's move on to rule 2. Deploy everything beyond your emergency fund. Wow, I'm going to get some negative comments already. Okay, this is a tactical cash buffer. It is not waiting for the right time. And I know some people, when you invest, right, you all keep some dry powder. You hold some cash on the sideline. Maybe you all even maintain like 10% cash buffer, 90% invested, 10% cash. Because some of you may feel that the market is too high right now, it's too overvalued. I'm afraid to deploy more money into the market. And I should always keep a piece of my buffer of cash. And that cash may be 10 to 20% of your entire investment portfolio. Or some of you look at Warren Buffett and say, Warren Buffett is keeping 30% holdings in cash. And the rest of you may be waiting for a crash buying opportunity, to wait for the market to crash, then you use your dry powder to go and enter the stock market. But let me present to you the truth and the fact. Your monthly income, as long as you are working or you are a business owner, every month you have revenue coming in, income, that is actually your crash buying mechanism. Because every month or every few weeks, the money will come in, right? That is building up your cash buffer, right? So your cash buffer, like I mentioned for rule 1, should be maintained at a fixed number or within a range, a fixed range. And anything other than that, you should be investing that. Because idle cash is only earning around 2% interest in a high interest savings account. While equities, they can compound at 7 to 10%. So if your cash is always idle, it will always be losing out. But I understand fully for some of you, you really need the cash buffer to feel safe, to have a peace of mind so they can be more aggressive in the stock market. Nothing wrong about that. It's just that you have to accept that you would have subpar returns because your cash is acting like a cash trap. It is not fully optimized and maximized. As long as you can accept the fact and accept that you are not fully optimized, I think it's good to have your own cash buffer. I'm just saying that based on my own rules, I wouldn't keep a large cash buffer or dry powder. I will invest everything above the emergency funds. But that's for me. And now let's move on to investing rule 3. Invest in index funds that track the broad-based diversified market index. Do not pick individual stocks. Now why I say this is a very important rule is because picking stocks look really sexy, really exciting. Every day you look at it, 10% up, 10% down. And then your heart goes up and down together with the stock market. How many of you are like that? Okay, your mood goes up in a good mood when the stock market is green. And your stocks rally 5 to 10% in a single day, you feel really shocked. But the next day, when the market corrects, your stock and your mood will go down together. So at least for a beginner, when you're learning the ropes of investing, it is very important to just track market returns. Accept that you will not have an outsized return. And it's okay to just follow market return, not having an outsized return of 30 to 40% a year. I know it sounds very exciting and you want to follow the strategy of other investment gurus, but I can assure you, I have walked this path before and it didn't end well. The only time it went well was because I was lucky in certain stock picks. But if you were to ask me again, I still feel that index funds is the way to go. And that will be the ultimate destination that you will end up with anyway. If you don't believe me, just wait a few more years. But I understand for some of you, you really like to study about stocks, study about the company, study about the CEO and the management reports. No problem. You just need to build your foundation and your fundamental holdings mainly in an ETF index fund first. Then you layer some high conviction names, maybe 3 to 5 companies on top of the index core. So it's a core and satellite position, but never focus 100% on individual stocks because it usually doesn't end well. Now, my investment rule 4 is to own the world and not just your local stock market or backyard. I know that Singapore is very familiar and we all have a very biased mindset towards our local country stocks. But here's the fact, Singapore is less than 0.5% of the global market cap. So if you're owning mostly local equities, that is concentration risk dressed as comfort because you're familiar with the name. You every day take bus or MRT, you see this name advertised. And I know how it feels because in investing, we are putting our own money into a company that we may not even see or heard, like in the global stock market. We don't even know this company exists until it is listed in the holdings. But Singapore company, we every day see. Every day here our aunties and uncles talk about it. So it may feel a bit familiar, but really, Singapore is just a very small market in the global world. So it's very important to just diversify across the world and not just focus on Singapore markets. Now, if you want to have exposure to Singapore market, I think one of the most important exposure is CPF, specifically the SA special account, because it gives you 4% guaranteed return every year as interest to your special account. So that will be your Singapore bond allocation. And to me, this exposure is good enough for local. In fact, your job, your HDB, your CPF are all localized in SGD. So really, most people, they have more local Singapore dollars exposure than you think. Moving on to rule 5, just keep buying. Yes, this is the title of one of my famous investment books that I read. And the fundamental reason to just keep buying is because the market usually trends up over the long term. And how you want to do it is not manually. It's to automate your regular savings plan or RSP. The strategy is called DCA. Every month money come in, money go out to investments. You set it up in the system and let it run. So when there is good news, you buy. When there's bad news, you cry a bit and you buy more. Okay, I borrowed this from Kelvin, but the truth is, bad news, you buy at a lower price with more units. Good news, you buy at a higher price but with lesser units. You don't buy after an election, you don't buy when there's news on geopolitical events, and not when the KIP ratio normalizes. Okay, you wait for some indicator, market trend indicator. No, okay, we are too busy to track that. And famous investor Peter Lynch already said this, and I used this sentence many times already. More money has been lost preparing for corrections than in corrections themselves. So you realize that all these rules stack together, like the cash position above the emergency funds, you should use it to invest in the market, and you just keep buying. You don't build a cash buffer, because remember the rule that people keep waiting for correction and crash buy, but they lose even more money because of opportunity cost. Which brings me to rule number 6. Never use leverage. Leverage means borrow money. So you borrow money either from your brokerage or some licensed loan money lender service. And why not to use leverage is because there's something known as margin call. It requires forced selling at exactly the wrong time and locking permanent losses, which means if your position suddenly half, the bank or the brokerage will ask you to top up the funds because you are in a margin position. And remember that in the market drawdown period, especially if you pick individual stocks, your portfolio will have to survive a 40 to 50% drawdown without panic and without forced selling. This is a very severe market crash already. So if you're in a leverage position, which means you borrow money or your margin, it's even worse, because now you're going to put in more money during a market crash. And that is very catastrophic. You already lose unrealized profits on your position and now you still have to put in more money. Okay, so the thing about not using leverage is not because you cannot find the opportunity, but you have to really understand that in investing, the position will grow with time and normal contributions, not of borrow money. Okay, if you are borrowing money, just do that, Either you are very knowledgeable or you have insider knowledge, or it's just gambling and speculation. So remember, do not use leverage. Rule number 7, do not trade any form of trading. Day trading, swing trading, whatever trade. And to tell you honestly, options are not passive income. Options is a form of trading. I think you don't need me to tell you that active traders underperform a simple index fund over any 5 years period after cost. Now, I don't care what strategy you have, the willing strategy, the covered call, the cash secured puts, your jet lizard, your iron condor, all these premium income. In a bull market, you'll feel very shook. But when the bear market comes and your positions are assigned in losses, that's where you will cry. And right now we are in a bull market, so you have a lot of option guru come up and teach classes already, which is true because I've seen this in 2021, exactly the same pattern play out. And the premium you receive from options trading is not free money. It's to compensate you for the risk that you're not being paid enough to take. You're picking pennies in front of a bulldozer. And I'm saying this as someone who has tried options trading in the year of 2021 to 2022. And I have stopped because I don't really enjoy it. And after I set up all these 10 investing rules, then my portfolio become clearer. And now the portfolio value really speaks for itself. Now, do I acknowledge that there are people very good in options trading for income? Yes, there are many people. In fact, some of them are my friends or colleagues in the influencer space. But the truth is that many of you cannot replicate the same performance because you don't have the emotions, you don't have the same mental capacity. So, can you be very good in options trading? Yes. But if you found out that you're not good in it, and you keep having losses, then please stop. In Chinese, we say 见好就收, and follow up say 见不好快收. That means that when the losses come and you know they cannot handle, then please take the L. Rule number 8, chase total return, not dividends. Wow, this one is going to be another controversial thing, because Singaporeans, we are so addicted to dividends. Anytime some people post about a stock or company, then someone else will say, does this company or stock pay dividend? I think it's an inherent Singapore mindset that we are always working for income. So we always expect some form of payout in the form of income. And in the stock sense, it's called dividend or distributions. Now, you have to remember that dividends are not free money. It is your own capital being returned to you. It's a forced liquidation of the company assets to pay out part of their cash flow to you. And the share price will adjust down by exactly the dividend amount or the ex-dividend date. So, if you really want to focus on a good company, a good investment, you should really look at total return. Why? Because you may be very fixated on getting the dividend, but you suffer a capital loss. So, you need to look at both the dividend and the capital gain. The total return add together, plus any foreign exchange gain or loss, that is the total return. That is what creates wealth in the long term. Now, are there very good companies who pay very good dividends? Yes, they exist, but they are fundamentally companies which can generate total return and they allocate part of it as dividends. If you're only using the dividend yield as a criteria to assess whether it's a good stock or not, I think that's a wrong approach to take. You should look at whether this company is good enough first. Then, whether it pays dividend or not is secondary. Is it a good company with very good financial reports, strong balance sheet, and good investment outlook? I think these are far more important, especially if you look at Singapore REITs now. It's a very clear local example of you chase the distribution, chase the dividend yield, but really destroying total returns through dilution and capital stagnation. I know it's going to ruffle some feathers, but this has been the fact, whether you want to believe it or not. Rule number 9, only sell when you genuinely need the money. So, I think the popular question is, you keep buying, keep investing, when should you really sell away your positions for money? I think there are two valid reasons. Number 1, you need the income for retirement, because when you are retired, you have no more salary, you don't have cash flow coming in, so you need to start selling your positions or you move on to dividend-paying stocks. The second reason is when you have a major pre-planned life milestone, like you are preparing for a wedding, you are preparing for your firstborn or a new baby, or you're preparing for housing or renovation. All these that require big ticket purchases and you need a huge lump sum of cash to, pay and afford the expenses. I think these are valid reasons to sell your portfolio for cash. But before you do that, you should always use the cash buffer, the 6 months emergency funds first, before touching the investment. Then you slowly wait for your salary or income to build up the cash buffer again. And if that's not enough, then you go and sell your position. And why you should not sell your position early, whether it's in profit or loss, is because you will miss the recovery simultaneously, whether it's for further potential capital gains or, recovery from a temporary loss. So once you have established that conviction in your stock picks or your ETFs, you really need to lock in. You don't anyhow sell just because it earns some profit, because you need to look at the long-term gain. Which brings me to Rule 10, invest for the long term and systems over willpower. And Rule 10 is the one I saved for the last because it's the only one that cannot be automated. Rule 1 to 9 are mechanics, some of them follow system, you can automate it, and any normal person who just read the rules can easily follow them. But Rule 10 is about human emotions really. Whether you can actually follow the past 9 rules when everything is falling apart, the market is crashing, the news media is telling you it's the worst time to invest and the worst market crash that we have ever experienced. And you see, the investor who earns 8%, they never panic. They will continue to build more wealth than the investor who earns 20% 1 year, but sells at every single correction to predict for the next market crash. Remember that human temperament beats intelligence every single time. You need to have the heart to stomach a market crash, and how you do that is to have your emergency funds settled. Then you set up the right asset allocation percentage of how you want to distribute your funds for investments. Then you all in and lump sum because the statistics already back up for the results rather than waiting for a crash to buy. So yes, I know this is quite a long video, especially for my 10 rules of investing. So I already published all this onto a cheat sheet that you can download for free on my Ko-fi page. And you don't have to pay money for this. All I ask is a little support to click on my interactive broker's link or scan the IBKR QR code if you enjoyed my sharing. So these are my personal 10 rules of investing. I know that it may not be very conventional and may differ from other finance creators. So what is more important that you write down your own rules before your next crash. I'm not telling you to follow me, but these are my rules. And you can adopt your own rules. You can even print out these 10 rules and paste it on your wallpaper or put it on your desktop. Every day you just look in. And every time you think that you're steering away from these 10 rules, ask your AI LLM to remind you, okay, these are my 10 fixed rules already. Where am I deterring? And the truth is, I really wish someone told me all these 10 rules earlier so that I can walk less one rule, or the wrong direction in my earlier years of investing. Now, if this has helped you, remember to share it to one person who needs to hear it. That's all I ask. And once you're fixated on these 10 rules, not just for me, but for yourself, then I want you to watch how to invest for beginners in my investment for beginners guide right here.